first up, let's talk about the earnings. The stock on our radar is Havells India. The company reported a mixed quarter. Revenue was higher than expectations on a year-on-year basis. Margins in the non-Lloyd's part of the business was a slight miss. We have Anil Rai Gupta, who's the CMD of the company, joining in now to discuss these numbers in detail. Thanks a lot, Mr. Anil Rai Gupta, for joining in and talking about these numbers on the whole. But let's start with Lloyd's. That was, one of the stellar performers of this quarter itself, backed by, good seasonality, etc. as well. Now, with EBITDA margins in this quarter being close to around 3% odd, the street is now looking at structural profitability of Lloyd. So if you could give us a sense of going forward, what is the kind of investment that you would make in Lloyd's? And will there be structural positivity? If yes, what are the kind of margins that you're gunning for here?
Well, I think we've always said that Lloyd requires long-term investments, and that's what we have been continuing to do, R&D, manufacturing, brand building, distribution reach. So those are the fair, investments that we have made and will continue to make in Lloyd, because we believe that it's a very large industry. Air conditioners is highly underpenetrated and it's at an inflection point of fast growth. So we'll continue to make these investments. Structurally, also, we believe that Lloyd has been making strides towards achieving efficiencies in manufacturing. So we believe that, and plus the brand perception, brand building, which will give us the right kind of pricing in the market as well. So we believe that we are on the positive trend, but we'll continue to make investments for fast growth in this business.
So the bottom line, Mr. Gupta, is that Lloyd continues to stay profitable, right?
I mean, quarter on quarter, it can vary because of seasonality, because still, even today, 70-75% of the revenues come from air conditioners, which is a seasonal product. But overall, structurally, there'll be a far better improvement over the past years.
Okay, that's good to hear then. If you have to niggle about these numbers, one factor would be the street was anticipating a little better margin profile. Do you believe on, put all your business together, Lloyd has turned it around, a couple of verticals did better, some of them a little bit softish. Double-digit margins should be what we should be working with, say in the vicinity of around 11% or thereabouts on an average for the year?
We actually look at, Lloyd's, which is an investment business, and Havells separately. But Havells, we do believe that, depending upon quarter on quarter, otherwise we gun for at least 13 to 14.5% margin in Havells standalone. And Lloyd, as I've already explained, is now towards a positive journey. Again, quarter on quarter can vary, but it is on a much better position than what it was in the last couple of years.
All right, so 13.5% margins in the Havells business, and Lloyd's, you are looking at investing, while structurally it has turned positive. Let's talk about a couple of other segments as well. The ECD business, that showed a strong growth for almost 20.5% as well, because of small domestic appliances and strong growth in fans as well. And this at the time when you've also tied up with a company, Jumbo Group, for kitchen appliances in the UAE. Wanted to understand the scalability of this vertical out here. How big are you expecting this business to be going forward?
Well, if you look at the fans business, which is a large part of this business, structurally, we believe that it is, highly penetrated category, but there is premiumization happening in this business. There is a high degree of newer retail, as well as the online business, which is coming up. Exports is a big opportunity. So overall, ECD, if you think, and small domestic appliances, our market shares are still small, and we can gun for much bigger growth there. Other than that, there are other segments in electrical consumer durables, water heaters, where we are the leaders in this business. We have the air coolers, which is also a fast growth business. So we believe that ECD has a good potential for growth in the coming times. Last couple of years, because of consumer demand, it has been a bit tepid, but I think going forward, ECD will register good growth.
Okay, all right. Mr. Gupta, in the cables and wires business, the growth was a little bit lower actually in comparison to a nearest peer, Polycab, which we just spoke to. But as per you, what kind of a market share shift was there? But from here on, I'm looking at a couple of brokerage roads, and they believe that you're perfectly positioned now to go ahead and pull back a good amount of market share, because your emphasis on R&D, digitization, brand positioning as well will help you on that front. So Where's your market share and how do you see it headed?
Well, overall, if you look at cables and wires segment, we have underground cables where we do believe that the new capacities coming up at our new facility in South will help us gain market share. But also, a sizable part of our business also comes from the wire segment, where it's a residential product, and the uptick in the real estate demand should help us grow in that segment. So we are looking at higher growth as well as market share expansion in cables and wires segment. Of course, when we are talking about the digitization, the overall R&D efforts, that's for the entire business of Havells and Lloyd, and that's continued investment. We believe that we are the highest spenders of R&D in our industry. We have a large base of R&D engineers of over 800 people. So with that, investments will continue in the entire business.
Right. So finally, before we let you go, we're first quarter in this financial year, in the middle of the second quarter as well. You have the visibility for pre-festive buying and all the other things that are happening. If you could give us a total roundup of what is it that you're looking at in terms of volume and revenue growth for at least this year across all segments, and what would that mean in terms of increased ad spends as well, which have been higher than what we saw on an average in the last 4 years rather?
Well, we usually don't give guidance, but on a general basis, I would say the first quarter has been a strong quarter. And with that, we are quite hopeful for the next few quarters to be a stronger growth for the business. And that's why we'll continue to invest in our ad spends. And, usually they remain between 3.5%, and that'll continue in the coming times as well.
All right. And you obviously have expanded manufacturing capabilities and looking to spend a lot more on capacity enhancement as well. But that's all the time that we have on our show today, Mr. Anil Rai Gupta. We will keep continuing our conversation as we speak every quarter, post your numbers as well, and get in some more details on this CapEx plan and what you anticipate in terms of growth coming in from here as well. Wish you and your team a very good luck.